Here is how you can triple your revenue without owning any property and without solely relying on Airbnb. So, what is this strategy? The strategy is the combination of working directly with insurance companies and working with a homeowner who is in need of filling out a vacancy. We are often have heard of the terminology called rental arbitrage, but typically rental arbitrage is done at the level of the go ahead and get a lease. You're on the hook for the lease, and then you go ahead and find a client. There's a model that we've used that doesn't require you to do rental arbitrage or solely rely on Airbnb, and that is the ability to combine co-hosting along with the midterm rental insurance strategy. What this means is you can even create a contract that will say, I will market your property to these insurance companies because I have relationships with these insurance companies, and our agreement only begins if I bring you a contract. That way there is no risk, there is zero risk, and this strategy alone can not only triple the revenue that the homeowner would make and also give you zero risk, which we love because we always want to make sure we get the upside and also limit our risk for any downside. So how do you do this? One of the opportunities that you want to focus this strategy in is by finding the right asset type. There is a demand for an asset type, either furnished or unfurnished. So if you're in a position where you're looking to possibly scale your portfolio or possibly even get your first property, there is a way that you can do it by starting first by getting permission of the homeowner to market the property to insurance companies, educating them that you've worked with people or you're working with someone or you've educated yourself by watching this YouTube video and that you know a place where you can list the property on their behalf because they most likely don't have the time or don't have the know-how. And when you do get an inquiry, when you do get interest, your contract will then come in action. If you're currently getting value from watching this video, you'll want to make sure you take a second and click below to grab the midterm rental insurance blueprint to help accelerate your process in being able to land these midterm rental insurance contracts with respect to your marketplace. Make sure you click the button below and grab it and continue on with the gems in this video. Always seek legal advice when it comes to making contracts. I'm not here to share the best terms of the contracts just because it can vary from state to state, but it's in your best interest at that point to form a contract with the insurance company and then form a contract with the homeowner. This contract in itself will make sure that the homeowner is also protected when you set it up. I like to do it with an entity so that you don't have to be held liable personally as an individual, and you remove that layer or at least add an additional layer of protection, right? So how it works is you're going to enter the property into the database. You're going to market it on Zillow Rental Manager, on a lot of different databases, free, some unpaid. Furnished Finders, a paid one, for example. Airbnb is free. And what you want to do, you're going to want to optimize for long-term booking. One way to do that is, having a 30-day minimum or simply waiting for the inquiry to come. When the inquiry comes, you have the discretion of being able to reject it if it's for the traditional stay and or accept it and move forward at least with a walkthrough of the possibility of having the chance to being able to have access and control the property so that when the inquiry does come in, you're in alignment so that you and the homeowner can grant access to that family. If they walk it and your numbers make sense, first gets approved, then they walk it, then you're green light to set up a contract. That is one way that you can expedite your process and being able to get into the space without owning any real estate, without having to take on the risk of getting a lease and then having to hunt for the client, without having to invest the inventory up front, inventory being furniture, which is typically anywhere, depending on the size of these homes, right? You can spend anywhere from $20,000 to $25,000 to furnish a home the right way. So this is a low risk opportunity. It is not a handout by any means, but it is a strategy that if you're willing to do the grunt work, if you're willing to go ahead and reach out to as many homeowners or investors in your area, you have then the ability to scale a midterm rental business on top of the short-term rental model that does not solely rely you to just rely on Airbnb. Now, keep in mind, Airbnb is one of the biggest OTAs. We don't want to cut the opportunity out and say, let's book direct. We want to leverage Airbnb. And so one of the things you do is you want to set up a 30 minimum stay, 10-day minimum stay, 7-day minimum stay to capture those longer term bookings that you can then bring on to the homeowner. And you always want to make sure that you're booked at a premium. That way, once you get the inquiry, you'll be actually very interested and excited to present it to the homeowner, because you'll know it'll be a number that they're happy with. Keep in mind, when setting up that agreement, it's always important for you to understand the homeowner's needs. What are their numbers? What do they want to net? What do they want to take home? Because then that will allow you to set your gross so that you can capture the difference in between. I like the idea of having probably some fixed structure. So there's an amount that we typically agree that we're going to pay out to the homeowner, either doing it that way or setting up a percentage. That's all with respect to how you want to do your business. I, however, like on the MTR insurance side, always like to carve out a bigger upside, which means that if you're telling me as a homeowner you want $6,000 for your property and then I'll end a $15,000 contract, I want to be able to make you happy and still maybe pay you the $8,000 or call it $7,000 or the $9,000, wherever that threshold is, but still have the ability to pocket the difference, which would be an additional $6,000 to $7,000 on my end for having done all the work. Make sure you structure that ahead of time with flexibility for growth so that your hard work does not go unnoticed, or I should really say you're compensated for doing all the work and the marketing that you're doing. Okay, so that's an opportunity that is very prevalent in the space that should most certainly be leveraged to the most extent, because that is one way that you can lower your risk and always capitalize on the potential upside that exists by operating in the insurance space. Call it the midterm rental insurance strategy combined with the co-hosting strategy, and here you are, you have more profits, more leverage points. Now let's discuss a fundamental difference in our industry, because these names can be used interchangeably, and it's very important that we understand which is which. What's the difference between rental arbitrage and co-hosting, really? So rental arbitrage is when I go to a homeowner, typically with my LLC, my business, and I say, hey, do you do corp to corp? The reason that works well is because you want to be able to first find a homeowner who's open to working with a corporation. Not all homeowners are willing to do that, especially other management companies. They don't like corp to corp. I don't know why. For me, it makes sense. Sometimes I think it goes back to the whole liability, where they want to make sure that they're having a one-to-one relationship and not one-to-many. But at the end of the day, the corporations that do accept are wise, because what we guarantee is a higher occupancy for them, and you're working with a corporation that is less likely to default on the payment, or at least has some reserves to be able to, at least you should definitely have some reserves if you're doing this business model, to be able to save for a rainy day in the case that you don't have bookings. So for me, it's a no-brainer from the company. But I guess if you have not vetted that company and you're uncomfortable, you're more likely to have a little bit of pushback if I come to you asking for a rental arbitrage, especially if I come in saying, you guys do Airbnb. People have a negative connotations, owners, property management companies, disruption, lack of quality control, which what it comes down to in the end, and dealing with third parties, which is tough, right? Because we don't always get to screen folks who come on Airbnb. That is one side of the spectrum, right? So the arbitrage is an opportunity. The other one is co-hosting, which is when you have the homeowner will go ahead and fill the furniture, furnish the place, set up the systems, etc. That fee is passed on to the homeowner for them to set up, and you as a co-host are managing essentially the property, the listing, the guest communication. You're not responsible for any dollars that need to come out of the day-to-day operations. You're there just to optimize the listing, speak to the guests, make the tweaks necessary to start getting bookings. A critical role that if someone doesn't have the time to operate an Airbnb, for lack of better words, or any B2B relationships, that is, you become essentially a marketer slash operator slash manager. I use the word manager loosely because from state to state, there's some requirements needed in order for you to qualify as a manager. I use the word loosely because the property manager is essentially just that, managing the property. But in this case, as a midterm rental or STR operator, aka co-host, you are co-hosting. It is the term coined from the Airbnb term being a host and having a co-host that sees all the visibility, communication, support, checking details, checkout, etc. Anything that rises to the surface that is not up to par or any assistance that the family might need, they'll reach out to the co-host, especially if indicated that the co-host is responsible for all communication. So it's like a partnership. Usually it is always a partnership with the homeowner, very transparent partnership. And there is an agreement, typically 25% of the gross revenue, top line, not profit, because it's important that you're getting paid for the time regardless of the bottom line, but it's the time that went into making sure that the deal is operating and bookings are coming in. That is why you'll typically get the top line revenue as opposed to the bottom. So again, huge opportunity if you're able to apply the arbitrage strategy or the co-hosting. The co-hosting is one that limits all risk, does not guarantee risk. I'm not here to say guarantees any risk, right? There's still risks of doing business, but it eliminates the most amount of risk. And for this reason, this is why in 2024, you should double down on this opportunity if it is available in your market, to then, of course, find the right asset type. We typically like 4-bedroom homes, 3 bedrooms minimum or more, okay? In order for you to reach out to the homeowner, get a co-hosting contract that lets them know that when you get a contract, this contract is in effect. When you get an insurance contract, put the two together, mark your overhead, mark their overhead, mark what they need to net, mark what you want to net, and then you take the spread. Limited risk, huge opportunity in the space to offer an increased occupancy for those homeowners who are facing vacancies. With that said, if you got value from this, make sure you grab the midterm rental insurance blueprint. Also, if you found this video to be helpful, make sure you check out my other episode with Kyle Stanley, scaling a short-term rental co-hosting business. Phenomenal co-hosting business done at scale. Want to make sure you tap into that video.